What if I told you you can consistently earn 12% on your money each and every year while outperforming the stock market, mutual funds, your IRA, or 401k? And unlike the stock market where you're constantly worrying about a downturn, you can do this safely without risking $1 of your principal investment. What if no fees were charged to you whatsoever? No management fees, no transaction fees, no load fees, absolutely nothing. And where your money was 100% secured and collateralized by an asset typically worth 25 to 30% more than your investment. Better yet, what if I told you you can literally sit back, do absolutely nothing, and continuously earn passive residual income without ever having to do much of anything? And through the IRS code, you can do this tax deferred, or in some cases, tax free. How quickly do you think you'll be able to grow your net worth using this strategy? What if I told you this unfair investment strategy, once only known about and used by the wealthiest of Americans, is now available to those of us who are smart enough to act on it? Well, what I just told you is 100% true and accurate. This investment strategy will deliver that and a whole bunch more. This is an alternative investment strategy that, when utilized, will increase your cash flows, your net worth, and your lifestyle, giving you more financial freedom than you've ever dreamed possible. If you're tired of earning 3, 5, or 7% on your hard-earned money, or if you're sick and tired of losing money in the stock market, I'm going to teach you how to earn 12% on your money year in and year out. It's a lot easier than you think. Sound too good to be true? Well, it's not. I want you to stay with me here, because what I'm about to teach you is going to transform your life, increase your net worth, and finally put you on the path to financial freedom. But first, let me tell you what this whole thing is not about. It's not a get-rich-quick scheme. It's not some pie-in-the-sky, made-up, untested theory. This is a real system for creating real wealth consistently and securely, and it's quietly being used by hundreds of thousands of smart investors all across America. As a matter of fact, love him or hate him, Mitt Romney used this strategy to earn $20 million tax deferred, and later on in this presentation, I'll show you which of the tools he utilized on how to garner that wealth and how you can tap into the exact same system. This is not some stock trading platform that's going to miraculously pick out the next Microsoft or Google. As a matter of fact, you'll gain super high returns, generally double-digit returns, regardless of how bad the stock market may be doing. This is not Forex or other trading currency. It's not about buying gold, silver, platinum, or diamonds, and it's not about bonds or mutual funds. And finally, it's not about keeping your money in a savings account earning you 0.5% a year, or a money market account that's earning you 1 to 2% a year. No, this alternative high return investment strategy is not about any of those things. But what I am about to teach you has everything to do with maximizing your investment returns, generally earning you 12% on your money safely, securely, and passively, day in and day out, as you go on and enjoy life. This strategy will double your investment money 4 to 6 times faster than having your money in stocks, bonds, or mutual funds. What that means to you is, if you invest, say, $50,000 in bonds, it may take you up to 24 years to double your money. 24 years. If you put $50,000 into a bond and it's earning you 3%, it's going to take 24 years to grow that 50,000 to 100. And if you're earning 4%, it's going to take you 18 years to grow that 50,000 to 100. Well, with this strategy that I'm going to teach you today on this presentation, it could cut that time down in half, down to 4 to 6 years, less than half. It's how the rich keep on getting richer, and it's how you can quickly and easily build your retirement accounts so you can live life on your terms, stress-free, and financially secure. For most of you, this is going to be the first time you've been exposed to this strategy. Others may have heard their wealthy friends talking about it at cocktail parties or other social events on how they're making a killing and laughing all the way to the bank. Well, I got news for you. By the end of this presentation, you too will have the opportunity of laughing all the way to the bank. All right, now let's keep on going and let's get started on the presentation. All right, before I get into the special educational event, I need to go over a few disclosure items. I want you to know first and foremost that I or any of my affiliated companies are not here to sell you anything. We're not looking to solicit you for money. We're not offering any type of an investment for you to buy into. We're not offering any type of securities for sale. All we're here to do on this presentation is offer an open, honest discussion on what you can do to increase your returns in a more secure environment and in a faster period of time. Second, I want you to know I'm not giving you investment advice, legal advice, or accounting advice. I'm not an attorney, I'm not an accountant, and I'm not a financial planner, and I'm not an insurance agent. Any of the statements I'm making and information I'm sharing with you is for informational purposes only, and you need to go out and verify all the information I'm sharing with you with the professional that you have on your team. And lastly, I want to disclose that every investment has risks, some higher, some lower than others, and this investment strategy is no different. However, I think once you understand how you can minimize your risk and secure your investment with that of an asset that's usually worth 25 to 30% more than what you're investing, you'll realize that the risks are lower compared to that of stocks, bonds, mutual funds, or anything else. Now, who am I and why am I sharing this with you? Well, my name is Billy Alvaro, and I wasn't born with a silver spoon in my mouth, didn't inherit a trust fund, nor did I go to an Ivy League school. But since 1999, I've generated tens of millions of dollars in 3 separate businesses, and I did well over 11,000 mortgage and real estate transactions, and did over $1 billion in business on an annualized basis. At 34, my companies were named in Inc. 500 magazine as the 136th fastest growing company in America. But like most successful people, including Donald Trump, Steve Jobs, Bill Gates, Walt Disney, Oprah, and even Abraham Lincoln, I've had my fair share of failures as well. Now, a lot of people don't like to talk about their failures. To me, you learn more from failing than you do from success, because it forces you to reflect and figure out what you could have done differently. It's from those failures that new, better strategies are born, enabling you to get to the next level in life. Over the years, I've gotten to network and know a lot of wealthy people, and I've come and realized that even though they were all from different backgrounds and they owned different businesses, different corporations, and had different completely fields, they all seemed to have one investment strategy in common, that was maximizing their wealth. My intent in this video for sharing is purely altruistic. My belief is now, at this moment in time, more than ever, people in America need to be exposed to and have the same opportunities offered to the mega wealthy. In this presentation, I'm going to expose the goose that's been laying golden eggs to the wealthy for decades, the people who folks at Occupy Wall Street call the one percenters. And I'm doing this because it's going to level the playing field to give you the same unfair advantage as the successful business owners and entrepreneurs that I know. Now, I want to be clear. If you want to increase your net worth, if you want to earn 12% on your investments, if you want to increase your retirement accounts and experience financial freedom, you will need to apply the strategies that I'm going to be teaching you. That means taking action on what you learn immediately. This is an easy process, simple really. However, you'll need to take a few action steps. Don't expect Financial Freedom Fairy to do it for you. You're going to have to take action. All right, now that you've gotten to know what I've done in the past, let's talk about today. Today I run one of New York's largest wholesale real estate redevelopment companies, Max Returns LLC and Easy Sell Property Solutions. We buy, renovate, sell, and in some cases keep for cash flow single-family and two-family properties throughout Suffolk and Nassau counties. In 2012, we've been involved with over 40 projects, each turning a healthy profit to the company and its investors. Our goal is to grow the company over the next 4 years to 200 projects per year by expanding our target areas to include Queens and Brooklyn, as well as a few other states. The investment strategy we will be sharing with you tonight has been the cornerstone to our growth and has increased our net worth and the net worth of many of our investors. We've been the recipient of 12% returns, and we've also paid out 12% returns. It was this one strategy that I've taken and used hundreds of times in my own life, and now I want to share it with you. So what is the secret solution? And how could you earn 12% fixed rate returns and double your net worth within a fraction of the time? The secret solution is, in our case, we're going to be talking about private investing in real estate as a private lender. So that is when regular people like you and I lend our money to a real estate investor to buy distressed or wholesale property at a tremendous discount. The funds to close on the purchase and make the repairs, which is basically the investor's money, in this case it would be your money, are secured by a mortgage, which is really a lien against the property that you and the real estate investor choose for your investment. Now basically, private investing is your opportunity to become the bank and earn a super high rate of return. A private investor is a passive investor, meaning they don't have to be bothered with toilets or with trash or with tenants. They don't have to buy, rehab, fix, sell, or manage anything. They make sure their investment is fully secured by a mortgage placed against the property, and they have a note which spells out the rate of return they will generally receive, which is 12% for short-term projects. Now, it's a well-known fact that a large majority of the wealthy have made their money in real estate. Everybody knows that. But what a lot of people may not know is that a majority of the people make their money by acting as private investors in projects. As the real estate investors are doing the hard work by locating the properties, fixing the properties, managing the properties, selling the properties, rehabbing the properties, the real estate investor is doing all the work, but the private investor sits back and collects money passively. Once upon a time, this whole secret strategy was controlled by and used only by the rich, or what I call the people in the know. It was spoken about at board meetings and their social gatherings, but today, the private investing landscape has changed. Along with the elite, the top 1%ers, a whole new breed of future wealth builders have been afforded these opportunities, and they include retired people, small business owners, hard-working employees, legal secretaries, divorcees, single mom and dads. It includes accountants, attorneys, doctors, financial planners, hedge fund managers, and any other professional that you can think of. The private investing landscape has changed dramatically. It also includes people like you and I. Now, you name the profession, and I'll show you someone who can, has, and is earning 12% in their money. So the question then becomes, why haven't you heard about this strategy before, and how can you become the private investor and tap into these wealth building strategies? Okay, you may be asking yourself, if private investing is this lucrative, if I can earn a solid 12% year in and year out, and if the risk is far lower than stocks, why hasn't my money manager, financial planner, accountant, or 401k administrator let me know about this? Well, the answer isn't as shocking as you may be thinking. The truth of the matter is, they don't tell you about this because some basically just don't know. They're not in the know. And others, they don't let you know about this because their plan or company doesn't offer it. And finally, some may not tell you about it because there's no way for them to get compensated on the investment. I'll go into that in a little bit. You see, if they don't know about it, or their company doesn't offer it, private investing as a solution, or if they can't get compensated on it, there's really no good reason for them to expose you to these strategies. If they were going to expose you to how the wealthy make a large portion of their money They, meaning your brokers, money managers, and advisors, would basically go out of business. Well, I mean, not really, but they would lose a good portion of their clients if they were to tell you exactly how they're making their money. See, with this information you're going to learn about, you'll finally be able to have your money work for you instead of having to work for your money. And you'll be able to do this without being dependent on a money manager, stockbroker, or financial planner. You know, I know a lot of people, maybe some of you that are watching right now, that have lost 20, 30, even 50% of their wealth in the stock market, in their 401ks, or in their IRAs. Overnight, you wake to find all your hard work and all your money that you invested has literally disappeared. Now, I don't have to tell you, stocks are risky. They're completely unsecured, completely uninsured, and when you invest, you buy them at market price. The returns, as you very well know, are generally unknown. Basically, what I'm saying is the stock market is uncertain. It's risky. If you attempt to invest in stocks on your own, and many do, you need to consistently watch, read, and react to what the market's doing. It's like having another full-time job. Now, don't get me wrong. It can make you a lot of money, but with it comes a lot of risk and a lot of time monitoring it if you were to go out and start investing in stocks on your own. There's absolutely nothing passive about managing your own stock portfolio. Now, some of you may be saying, well, yeah, no problem. I hired a financial planner or a stockbroker to watch it for me. Now, I want you to think again. Do you honestly think anybody cares more about your money than you do? I don't think so. The truth is, stockbrokers or money managers make their money based on the trades that they do on your behalf. The more they trade, the more money they make. Most don't have their commissions tied to your financial gain or loss. Unfortunately, the whole system isn't set up that way. If it was, I guarantee you, your stockbroker would be doing a whole hell of a lot better for you. Now, some fund managers get a percentage of the money that they have in the management. So basically, you're paying them a hefty fee to manage your money, regardless if they grow your portfolio or if they lose you money, they still get paid a hefty management fee. Now, what I'm not suggesting is that you withdraw all your money from your money market accounts or your money manager or your stock accounts, nor am I suggesting you cancel your trading accounts. I'm simply trying to educate you in the fundamentals so you can understand how this alternative high-yield investment strategy and process will work for you. Personally, I believe in diversification. I believe in having some money in a really low-risk, low-return account, like maybe a bond. I believe some money being managed by a money manager. But if you really want to build wealth and build it fast, you're going to need investments that are high returns, like the 12% returns I'm going to be speaking about tonight. High returns with low to moderate risk. Now, don't get me wrong about financial planners and money managers. I know a lot of great ones. There are some very good, educated financial planners out there. However, as I said earlier, no one, and I mean absolutely no one, is going to care more about your money than you do. All right. A lot of people watching this presentation can relate to the financial roller coaster ride as you see here in this picture. When you're investing in the stock market, it's a constant up and down swing. The market is emotionally draining and oftentimes devastating. Individual stock prices can plummet overnight if their expected earnings on Wall Street don't meet expectations. People from all walks of life have seen their IRA, 401k, or other investments literally sliced in half. Now, worse yet, most people think because they're invested in mutual funds that they can escape the up and down roller coaster ride as seen in the stock market. But what they don't realize is that they're at the mercy of the fund manager to ensure that he or she mitigates the risk and hedges losses. See, with that comes a cost in the form of management fees, which I don't know about you, but I'd be happy to pay. But what I'm not happy about is having a team of highly compensated experts manage my money and manage my account and then only get me a return of 5 or 6 or 7% on my money. To me, that's 100% unacceptable, especially because most of these highly compensated people that are managing your money have their own money in things that I'm going to be speaking about tonight that are earning them 12%. See, that to me, it just doesn't make any sense. If they have their money in investment accounts and in private mortgage notes that are earning them 12, why wouldn't they offer that to you? To me, it makes more sense to do what my wealthy friends do and what I do, and what a lot of other people who have been exposed to this investment secret do. That is, take a large portion of their money and put it to work for them, earning 12%. Oftentimes, you can do that tax deferred in a more secure environment and fully backed and securitized by an asset that's usually appreciating, and in this case, we've been speaking about real estate. There is no other investment that I know of that can do that. I don't know your personal financial situation, but I can say this. If you want to jump off the roller coaster ride that the financial markets have been doing and get into a highly profitable investment vehicle like the 12% solution, I want you to grab a pen, close your door, turn off your cell phone, and I want to get into the nitty-gritty. All right, so here's a good exercise. Let's look at the investments on this slide, and let's go through each investment line by line. If you don't have this document printed out, you can use a piece of paper, but it's important for you to see what each of these investments is earning you, because in the next section, we're going to discuss what the risks are with each. Now, let's just go down this rather quickly. In your savings account, what do you think you're earning? I'm saying between 0.5% and maybe 1% if you're lucky. How about your money market account? What do you think the annual rate of return is there? Possibly 2, maybe 3%? How about your mutual funds? What are they earning you after you pay out all your management fees? 5%? If you're lucky, 7%? I know a lot of people that are earning 4 and 5 on their mutuals, and the same thing in their 401k or IRA. Now, the stock market, who knows what you're earning? You know, one month you're up 30%, the next month you're down 42%, so it's just so unpredictable on what you can earn in the stock market. We have no idea. And the last thing here is under your mattress. Well, if you have money stored in your house in a safe or under your mattress, you're basically earning 0. And I want you to look at this now, because private investing, the annual rate of return, is going to give you 12%. Now consider this. If you're earning between 2 and 4% on some of your investments, like stocks or like bonds or money market accounts, you can very well be losing money. Now let me explain what I mean by that. You have to, if you don't have a piece of paper, I want you to get one. Let's just look at the inflation rate for 2011. Now, as noted in usinflationcalculator.com, you can go right there and verify this. In 2011, inflation was 3.2%. So what does that mean? It means that your dollar from the beginning of the year to the end of the year is now only worth 96.8 cents. Basically, inflation has devalued your dollar by 3.2%. So your money today is worth less at the end of the year due to inflation. You can accumulate more, you can accumulate less with the same dollar. Now, if you're earning 2% in your bonds and inflation is at 3.2%, how much did you actually earn? Well, I got news for you. You look at these numbers, and these are real facts and figures, you've actually lost money. You've lost 1.2%, or basically 30%. 1.2%. If you're earning 2% and inflation is at 3.2, you're at a negative 1.2% because your returns on the bonds have not outperformed the inflation rate. Now, what's worse? If the bonds were not tax deferred or tax free, you may have a 2 or 3% loss after taxes. In plain English, dude, I'm telling you straight out, that absolutely sucks. It's no way to get wealthy. It's not the way the wealthy become wealthy, and it's certainly not the way that you're going to be growing your wealth moving forward. Now, most people think because if their money is in bonds or CDs, it's safe and secure, and it's a wise investment. It's definitely safe, and it's definitely secure, but it's unwise to keep all of your money. Notice all of your money. You should have a portion there. But it's unwise to keep all of your money in that safe, secure, low return investment. Now let's look at some of the risks and rewards each of these investments brings to the table. Now in this chart, basically what we're doing is we're comparing investing in private mortgages as a private investor versus the stock market, mutual funds, money market, CDs, savings, keeping your money under your bed, or in precious metals like gold or silver or platinum. That's across the whole top portion of this screen. Now on the left-hand side, we're looking at each one of these items and we're saying, is it a secured position? Is it secured with collateral? Are you buying at a wholesale position? Is it an appreciating asset? Is it insured against natural hazards? Does the ROI beat inflation, and is it passive? Now you can print this out if you'd like. I'm going to go through this and explain to you what we're doing here. When you compare the overall risk versus rewards as a private investor in mortgage notes to what the general public is going to invest in, you're going to quickly realize that nothing comes close. Take a good hard look at this chart and you'll see why most people are exposed to private investing immediately start investing in private mortgage notes. Now you don't need a PhD, nor do you need to be a rocket scientist to understand private investing is the investing choice when it comes down to earning high returns with minimal risks. It's the reason why people like you and I wind up investing a large portion of our money into private real estate notes. Now, when compared to the stock market or mutual funds, your private mortgage note investment is fully secured and collateralized against a real asset. Now, in this case, as I mentioned earlier, that real asset is a real estate, meaning there is a tangible asset tied to your investment. Now, if you compare that to the stock market, your investment there is secured against nothing really. There is no hard asset associated with your investment in the stock market. Therefore, even though you can realize good returns with stocks, the risks associated with returns do not measure up to that of a private mortgage note investment. With private mortgage notes, you're also investing in a wholesale position, meaning the asset, the real estate, is generally worth 25 to 30% more than what you have invested as the private investor. And it's an appreciating asset. So to give you an example, if the properties you're buying, if the ARV, which stands for after repair value, is $100,000, then your investment will be no more than $70,000. That's giving you a wholesale position in the asset. You basically have a $30,000 cushion. Very smart. When investing in private mortgage notes, you'll also insured against natural disasters. So, if in the unlikely event the asset, in this case the house, burns down in a fire or gets ripped apart by a hurricane, the hazard insurance policy on the property fully protects your investment. There's only two investments that offer that besides private mortgage notes, and that's CDs and savings accounts. Both have a security instrument attached to that type of an investment. But as you know, both of them also offer anemic returns. Now, as noted in the previous slide, investing in private mortgage notes, your returns will definitely beat out inflation. And this is important to understand. Many people think because they have their money in CDs or a money market that it's a smart investment choice, mainly because they know what their returns are going to get and because it's secured or insured. As I explained previously, if all of your money is in an asset that's yielding you 2, 3, or 4%, you are not building wealth, nor will you ever be financially free. If you want to create wealth, have a secure financial future during retirement, you must diversify a portion of your investments into high-yielding, collateralized assets like private mortgage notes. Finally, and the most exciting, investing in private mortgage notes generates 100% passive income, which is one of my favorite parts of being a private investor. Earning high returns passively is a surefire way to financial freedom. You do nothing, and you get paid. Now, what I want to show you next may disturb you, and at the same time it may excite you, but the reason will be obvious. We're going to take a look at how much money you could be losing if you invest $100,000 over 10 years into, let's say, a bond or a money market account, versus what if you invested it into a mortgage note as a private investor, earning you 12%. Let's take a look at that. Okay, by investing just $100,000 over 10 years at 12%, that initial $100,000 investment would have more than tripled, ballooning to $310,585. Tremendous. That is a huge increase in just 10 years with $100,000 that you invested. That is what high yield investments such as private mortgage investing will do for you. When you take the next step and direct your money as a private investor, you'll start earning what other smart investors are earning. Or, as you'll see in the next slide, you can follow the herd and do next to nothing over the same 10-year period of time. And if you're investing in in bonds or CDs, you'll see right here in this slide that investing $100,000 into a CD that's earning you 3%, over 10 years, it's going to earn you a measly $34,391. Compare that. Would you rather have $310,000 at the end of 10 years or $134,000? To me, the answer is obvious. The difference in what you have earned is dramatic. It's a whopping $224,000. Now that is a lot of money, people. That is what most people don't understand about investing. They've been brainwashed into investing into the normal group of investment vehicles, the low-risk ones like bonds or CDs or money markets, as in this example. And they really do nothing by way of getting you to the path of financial freedom so you can live more comfortably and more financially secure in the future. What it does is it keeps you exactly where you are financially. It gives you no real wealth at all. I mean, earning $34,000 over 10 years off of a $100,000 investment, to me, frankly, it's insulting. Especially when you consider that this alternative investment strategy, which is private investing, can more than triple your earnings, turning that same $100K into $310,000, while being much more safer in stocks and more dependable returns in your IRA, 401K, or mutual funds. And what I'm hoping is that the light bulb goes off in your head, that you realize these alternative investment strategies create massive wealth at an accelerated rate in a more secured environment because it's backed by an appreciating asset, in this case, a wholesale position, real estate. Just keep this in mind now. Your investment capital more than triples over a 10-year period when earning 12%. Invest $100K and it grows to $300K. If you invest $250,000, it grows to over $800,000 in 10 years. And here's the kicker. If you're lucky enough to have $500,000 to invest over 10 years, it's going to grow to $1.6 million. Private investing truly is the path to financial freedom. Here's just a quick snapshot of the annual growth of your capital over 10 years. As you can see here, you're starting off with $100,000, and by year 3, you have $125,000. By year 7, it's $221,000, and by year 10, you have a whopping $310,000. Now, this is just starting off with $100,000. Now, I've shared this information with tons of people, and before they really understood the power of private investing and how it compares to other investments, they always ask me one question: why should I become a private investor? At this point, it should be obvious as to the reasons why anyone should become a private investor. But let me go over the benefits. And some of the benefits include higher rates of return, a dependable investment as high as 12% annually. Investments are collateralized by an appreciating asset, which I said earlier, and in this case it's real estate. You're in a secure position as your investment money never ever exceeds 70% to the after repair value of the property, which is known as LTARV, loan to after repair value. So meaning that if you have a $100,000 after repair value on a property, you won't be into that investment for more than $70,000. That means you have a 30% equity position as the lender, so you're fully secured. Also, you earn money passively. There's no need to fix, flip real estate, worry about tenants, trash, or toilets. You earn a high rate of return without having to do much of anything. And the real estate investor goes out and does all the manual work. As I mentioned earlier, your investment is secured and insured against any hazards such as flood, hurricane, or fire. And because there's no other investment out there that has such a low risk factor as private investing but offers such a high rate of return. The number one thing I hear most from private investors after they do their first investment deal is they wish they would have known about this strategy sooner. What I've told them and what I'm going to be telling you is that it's never too late to get started. There's no better opportunity than now to get your money working for you. There's no better opportunity than now to start earning 12%. There's never been a better time to start taking action now. Now you know, and I don't have to tell you, time goes by quick. In a blink of an eye, 5 years will pass. And the question I have for you is, what will you do differently today that will change your financial future and your financial world tomorrow or 5 years from now? If you do nothing, believe me, expect nothing to change. I can remember back a few years ago when I was sharing this strategy with a small group of 5 people. They all belonged to the same club, and we were all friendly. They saw what I was doing, and they had questions, and I basically went through everything with them to see what they were doing. They all had a similar net worth, within a few $100,000. They all were in different businesses. 3 owned a business, 1 was retired and extremely wealthy, and 1 worked for a company. Now what I did is I coached them on these strategies, how to get started as a private real estate investor. Gave them all the tools and information they needed. 3 of the 5 of them contacted me afterwards to jumpstart their investments and to put their money to work. Over the next 6 years, and I'm still friendly with these guys, 3 investors started earning a substantial portion of their wealth as private investors. Their net worth grew, as did their commitment to this investment strategy. Now the sad thing is 2 of the other fellas, they never got started. They let their newly acquired knowledge lay dormant, never taking action. As their 3 friends who started private investing grew their wealth substantially, one of the other 2 saw his portfolio and his IRA cut down by 34% because of the high-risk investments that he was in. And the other, well, he was almost exactly where he was net worth-wise 6 years earlier. Now listen, if you want to change any area of your life, you have to do one thing, and that's take action. You see, this is a reoccurring thing that I'm saying to you. If you take this information and learn it but don't use it, you can't expect anything to change. You can do what the other 2 fellows did, which is nothing, and you'll gain nothing. Or you can take action like the first 3 gentlemen did and transform your net worth into financial freedom. All right, so now that you know why anyone should become a private investor, you may be asking yourself, why in the world would anyone ever pay me 12% to borrow my money if it's secured by real estate, especially when mortgage rates are at record lows? I'm going to discuss that in the next slide. All right, there are several key reasons why savvy real estate investors would gladly pay you 12% to borrow your money. Even though mortgage rates are at historic lows, tens of thousands of real estate investors continue to pay private investors like you 12% for the use of their capital. Now, why in the hell would anybody do this? Why would they pay 12%? Well, because it's not the cost of money that's inherently important to successful real estate investors. Rather, it's the speed and the availability of the funds. Let me explain what that means. You see, real estate investors like myself buy distressed properties at steep discounts for a profit. Many times, the properties purchased are so distressed that the banks take a long time to evaluate a loan package. This usually kills the deal. Speed is a real estate investor's best friend. The best real estate deals are made when the real estate investor can close fast and pay cash. So when banks delay, meaning the banks that are going to lend the money to the real estate investor, when they delay and they're too slow to fund the deal, the real estate investor loses great deals. Because real estate investors buy for a profit, paying a high return like 12% on borrowed money really is just akin to giving a little profit away to the lender like you who helps get the deal done. It's a win-win opportunity for both the lender, meaning somebody like you, and the borrower, who is generally the real estate investor. The lender gets an opportunity to earn high returns secured by great real estate deals, and the borrower, who's the real estate investor, gets to keep their business profitable without the limitations and delays usually imposed by traditional banks. It's a win-win for everyone. See, in our business, we're doing between 6 and 8 profitable rehabs on a monthly basis. We're able to grab these highly profitable real estate deals quickly before anyone else because we act with lightning speed. When an opportunity presents itself, we do our analysis, and if it passes our due diligence, we contact one of our preferred investors to fund the deal at 12%. We would not be able to do a fraction of the deals that we do if we had to rely on our own cash or funding from a traditional bank. We'd only be limited to a certain amount of deals that we can do. See, to me and to all my private investors, our relationship is a marriage made in heaven. We win because we're able to do highly profitable real estate deals, and our investors win because they're able to earn 12% on their money passively with little to zero stress. Now, if you're considering getting into private investing, I want to share with you how to go about evaluating a real estate deal so you can ensure that it's a really good investment that you should put your money into. It's fairly simple to evaluate the risk and the potential opportunity of a private mortgage loan. Let me explain. You see, real estate investors buy properties at huge discounts and borrow funds well below the market value of the property securing the loan. Equity and your maximum loan to after repair value, LTARV, are your safety net as the investor and your primary point to consider in every deal. So here's how you do that. If you're investing with a professional real estate investor, generally they should supply you with an investment summary page which will outline the after repair value, the rehab costs, and the amount requested for the investment, and the LTARV, loan to after repair value. If you don't have a savvy real estate investor who does their homework, you'll need to take these steps on your own. But I can tell you, if you're not investing with a real estate investor who does this, you might consider not investing with them. Now first, you need to determine the after repair value. That's the ARV of the property being considered for the loan. This can generally be done by reviewing comparable properties. Second, after you determine the ARV, you must consider the estimated fix-up and repair costs. This should be provided to you by the real estate investor that you're considering making a loan to. Now, if you're unsure whether the estimate being provided to you is accurate, you should ask a licensed contractor to provide a bid. Once you figure out the ARV and the repair estimate, you're almost there. The third thing you must consider, the purchase price of the property. Once you know these three numbers, you can evaluate your total LTARV, loan to after repair value, which should never exceed 70%. Let me repeat that. You never want to exceed lending out 70% of the LTARV. You never want to put out, so if a ARV is $100,000, your maximum loan to them is going to be 70%. That's the maximum that you want to put out. So here's the formula. We can do this broken out, and you can see it on this chart. You want to take the purchase price and you want to add the repairs to it. And if you add those together, that equals the loan amount. You want to take the loan amount and divide it by the ARV. That gives you the LTARV, the loan to after repair value. So let's look at these numbers. Your after repair value is $135. Your repair costs are $29,000. Your purchase price is $66,000. If you add those together, you get a $95,000 loan amount. You then divide the $95,000 by the $135,000 after repair value, and you come up with a 70%. It says on here LTV. It's 70% AR LTV, after repair loan to value. Now, if your loan meets the foregoing formula, plus or minus a few dollars, your risks are reduced and you're likely making a really good private mortgage loan. Now that you have the formula to evaluate whether your loan is a good investment or not, it's time to explore several things to consider in the world of private investing. Now, in the world of private investing, there are many types of investments being offered. During this training, we've been speaking about the 12% solution. Mainly, these are short-term notes, generally 6 to 12 months, which the real estate investor uses for the purposes of buying, remodeling, and then reselling for a profit the real estate. These investments are generally paid out to you, the private investor, when the real estate investor sells the house at the end. There are also long-term investments offered by real estate investors. These investments are generally secured against rental properties, which generate a cash flow for both the real estate investor and the private investor. Generally, because of their long-term nature, you'll get a yield of between 7 and 8% fixed rate of return on your investment, which the interest earned is paid out on a monthly basis. This type of investment is great for those private investors who want to receive a monthly return on their capital. These investments, though, follow the same rules that the 12% solution follows. Never put out more than 70% of the LTARV, period. Now, the last of the private investments are what are known as flash cash funding. This investment is a super short-term note, anywhere from 1 day to 1 month, and generally the private investor, meaning you, receives a flat fee for the money invested. It's a highly profitable investment, and like I said, 1 day to 1 month, and you're making a nice return on your investment. Now, regardless of which one of these investments you choose, you want to make sure that your investment's secured. We're going to go over exactly what documents and what we have to do and how you're secured with your investment in the next slide. Okay, so how can you, a private investor, minimize your risks and secure your investment and still get a high rate of return on your investment? Simply put, you'll invest in projects where you have at least a 30% equity position, and you'll invest in projects where the real estate investor has the experience and the expertise in real estate investing. But equally as important, you'll want to secure your investment with a few documents. I want to go over them now. Those documents include a mortgage or a deed of trust, depending on which state you live in, a note that spells out the rate of return that you're getting, and it has an insurance policy. Now, the buyer of the property will also get title insurance, which will generally give you clear and marketable title, free of any liens or judgments or any other encumbrances. Finally, you'll want to invest in and with an experienced real estate investor who has a proven track record. Don't make the mistake of investing in a project where the real estate investor has only a few properties under his belt. Or worse yet, this is his or her first deal. It's important for you to surround yourself with quality people and a quality investment opportunity. Now let's go through each one of these documents one by one so you can get a deeper understanding of what each one is. The mortgage on the property will protect your investment by securing it with a piece of real estate. So basically you're going to lend money and you're going to put a lien on the property, which then becomes tied to that house, so the real estate investor, if he decides to sell it, he can't do anything without paying you off. Now the cool part is your investment, your money you invested, is 100% secured by this piece of property, which is generally worth more than 30% of what you're investing. Now think about that. When you invest in stocks, does the CEO give you a lien against his or her companies or his or her assets? Absolutely not. No way. Your investment in stocks is dependent upon their performance. One bad report and 30% of your investment literally can disappear overnight. Now, with a mortgage on a property, the asset your money is secured against is worth 30% more than what you've invested in. You're in a very secure position. Now, the other document, the note, clearly spells out the terms of your investment. It states how long the investment will be for, what the rate of return is, and it's also signed by and guaranteed by the company whose project you're investing in. Next document is the hazard insurance, which protects the asset from many risks like fire, water damage, or hurricane. Now let's recap on how to minimize your risks and better secure your investment. Quick recap here. Invest no more than 70% of the ARV. After repair value, ensure you're investing into a project that is owned or run by an experienced investing expert. Secure your investments with a mortgage, a note, and hazard insurance policy, and make sure that the buyer of the property is getting title insurance. Now, I'm telling you from my years of experience, if you follow these guidelines, if you follow this roadmap that I'm laying out for you, it is the blueprint that I've used and countless others have used to become financially free. But even with this blueprint, there are risks. Like what happens if the real estate investor decides not to pay you back? All right, what happens if the real estate investor stops paying you on the private mortgage loan? Actually, there are several options, but first and foremost, please be aware that integrity must be an essential part of your real estate investor's business. But even with all your due diligence and all the proper paperwork to secure your investment, what if things go wrong? Well, you do have options, and I'm going to discuss them with you now. For starters, you could negotiate and restructure the payment schedule on the note. So, for example, let's say the note is due, but the real estate investor doesn't have the house sold yet. Now, you could extend the note for another 3, 4, 5, or maybe even 6 months. You can have the real estate investor deed the house over to you, profit by reselling the property. Number 3, if you're left with no other choice, you can simply foreclose. Now, foreclosure isn't as time-consuming and as costly as many people think. It's as simple as sending your note and mortgage to an attorney and saying foreclose. All you have to do then is sit back and wait. 9 times out of 10, before the foreclosure is complete, somebody from the real estate investor's office will be calling you for a payoff letter, and your loan will get paid off. When this happens, you will collect all your accrued interest, your principal balance, your attorney's fees, any court costs, and any other expenses that were incurred with the connection of the loan. So if you wind up with the house, that doesn't mean you have to keep it. It could be sold immediately at a fair price, and you can still produce a profit above and beyond what you already have inside the loan. Now, we've talked extensively about private investing, what it is, why anybody would want to become a private investor, why real estate investors are willing to pay 12%, how to figure out if it's a good deal, what documents you need to secure your investment, and what options you have if your investment goes south. Now I want to talk about how to actually fund a private real estate deal. Just the dynamics, give you a small diagram to show you what the process is and the steps are if you should then go ahead and start investing in private mortgage notes with a real estate investor. When you're ready to make a private mortgage loan, your money will go from your bank account directly to the closing agent, generally the attorney or the title company, in the form of a cashier's check, but usually it's in the form of a wire. Now, the real estate investor will not touch the money until after all your funds have been properly secured by the real estate. The closing company will assure that this happens. At the closing, the title company and the attorney will make sure that the real estate investor signs a promissory note and the mortgage or deed of trust, depending on what state you're in, and that everything is properly recorded and documented. The attorney and title company will also ensure they follow the closing instructions and escrow instructions, that all other documents that protect your interest are in proper order and signed. Now let's take a look at the flow chart so you can see and give you a visualization of exactly how you'll fund the private real estate transaction. Alright, so this is a flow chart of how a typical transaction would go about getting funded if you, the private investor rather, wanted to invest in a real estate deal. So basically here, you have money in your self-directed IRA or 401k or stocks, bonds, mutual funds. Somehow, some way, you have some money to invest. Now what happens is a real estate investor would locate a house to buy and provides you with the details to evaluate. Right here, there should be a little something, but it's missing. And it should say, once you guys agree, you would then wire the money to a trust account, which is controlled by an attorney or by a title company. Now at the formal closing, you receive 4 documents. And we went over those documents earlier. And those documents would secure your position and your investment. The real estate investor then goes ahead, after he purchases the property, he starts to renovate the property. You're earning 12% simple interest on your money. The real estate investor then goes ahead and sells the property or refinances. Either way, you get paid off, and boom, you get paid off and you receive your original principal amount plus all the interest that you earn, which in this case is the 12%. This flowchart is 99% of the time on how it happens. Now, depending on the relationship that you have with your real estate investor, well, maybe some of this information on here may change. But for the most part, this is the general workflow that you're going to be following when you go ahead and go to invest into a private real estate deal. All right, now that you understand the process associated with how you would invest in a private real estate deal, let's briefly speak about where you would find the money to invest so you too can start earning 12% returns. Now, a few of these items I'm going to be speaking about are obvious, but 1 or 2 of them may not be. The obvious is to invest money sitting in your savings account, money market, or CDs, and cash, as these investments generally are yielding you less than 2%, and in most cases, 1%. And with cash under your mattress or sitting in your checking account, it's earning you literally nothing. It may only make sense to put this money to work and to start earning a whopping 12%. Now, there's no reason to continue to allow your money to sit idle in these low return vehicles, knowing what you currently know now. The other obvious places where you find a capital is to invest in private real estate deals, is money held in stocks, bonds, or mutual funds. Instead of enduring the proverbial roller coaster ride associated with stock investing or the high costs and management fees associated with mutual funds, you now have an alternative investment vehicle that will outperform the stock market, earning you a consistent, and that's the key word here, a consistent 12% fixed rate of return with 0 management fees or any other costs. It's one thing I need to stress to you. When you act as a private lender, a private real estate investor in real estate deals, there are no costs to you at all, 0. Now, if you're lucky enough to have equity, an equity line on your house or a second home or investment property, you may want to look at what rate of interest you're paying. You see, if you have a line and you're paying 4.5% or less, you can, in essence, do exactly what every major bank in America does, and that's earn the spread on borrowed money. Now, let me shed some light on this, on what I'm talking about. When you deposit money in a bank account, let's say in your savings account or CDs or money market or whatever, you're giving the bank your money, and in return, they're paying you 0.5% to 3% if you're lucky. Then, what the bank does is it takes your money and that of all the other depositors in the bank, and it lends it right back out to you in the form of a business loan, a personal loan, credit cards, car loans, even mortgages. And when they do, they charge you a higher rate of interest than what they're currently paying you on your deposits. See, if they're paying you 1% and they're charging you 18% on your credit cards, they're keeping the 17% spread as a return on their investment on borrowed money. You see how sick that is? It's a phenomenal concept. Now, by using your low rate equity line, you can do exactly the same thing. You can earn a spread borrowed off of borrowed money. Now, I used this exact same strategy for years when I first got started, and we continue to use that strategy today. Now, if you're a business owner and your company's throwing off excess capital, it may be wise for you to take that capital and to put it to work outside of your business and invest it in private real estate notes. But if you're in a growth mode and you need that capital to fuel your own business growth, then it might not make much sense. However, if you own a business or not, you may not know that you can use your 401k and IRA money to fund private real estate investments. I want you to take a look at this article from Forbes magazine. Let me actually read it to you. Self-directed IRAs will shine. And this was taken directly off of Forbes, and I believe it was in the middle part of 2012. Let me read it. For years, wealthy investors have been using the benefits of the self-directed IRAs to grow their net worth. In fact, many people were surprised to learn that Mitt Romney had accumulated more than $20 million in his IRA because he owned his former company's stock with it. Others have used the power of the self-directed IRA to buy and sell residential and commercial real estate. And now, savvy entrepreneurs will have a huge opportunity to use self-directed IRAs to attract new capital. In fact, I expect the self-directed IRA market to experience dramatic growth in the next few years. According to a report by the SEC's Office of Investor Education and Advocacy and the North American Securities Administrators Association, currently less than 2% of the $94 billion of the estimated $4.7 trillion in IRA assets are held in self-directed programs. Now, this is the most powerful wealth creation strategy available. When combining private real estate investing with self-directed IRA or self-directed 401k, you can literally explode your net worth extremely quickly. In all my years of being in business, I've learned a ton of lessons, and one of them is if you want to build wealth and become successful, study and learn from those who have already done it. The fastest way through the jungle is to follow the path that's already been blazed by the ones before you. Basically what I'm saying is don't recreate the wheel. If Mitt Romney, Donald Trump, Warren Buffett, and other countless mega millionaires and billionaires are using and benefiting from this strategy, don't you think they know something that you don't? Now, if you're bright, and I'm thinking that you are because you're on this call, or I'm watching this video, you should be thinking, what is my next step to investing with my IRA or 401k? And there's a bunch of things that go into it, but I want you to know, there's only 2% of the people in America that are doing this. And there's no connection, or there is a connection with the richest 2% of the people in America. If you want to jump on this bandwagon and start using the exact same strategies that Mitt and Trump and Warren Buffett are using, I'm going to expose that to you in the next slide. Alright, here's a brief overview of the strategy. It's called self-directed IRA or self-directed 401ks. Now, it's different from your regular IRA and 401k plan, as with the regular ones, your plan administrator generally invests your money into what they choose, which frankly, if you have money invested in an IRA or 401k, you know your growth rate is probably not too impressive. Now, with a self-directed IRA, you, the person whose money it is, you direct the plan administrator to invest in what you want to invest in, which can be private real estate notes, act as a private lender, into real estate. You can buy tax liens into businesses, gold, silver, and these are just to name a few. Now, if you're smart like Romney, Trump, and Buffett, you'll choose high return investments such as private investing strategies that you're learning today, which you could earn 12% tax deferred. Now, don't get discouraged if you call your plan administrator and you ask them if you can direct your money into an investment of your choice. The answer will most likely be a quick no. You can't do that. And the reason is regular plan administrators don't allow self-directed IRAs. Now, don't worry. There are many administrators whose sole focus is in the self-directed IRA and 401k world. Switching from your current plan administrator to one of the two we use and recommend is not difficult at all. With a few simple documents, you can start directing your plan administrator to invest your funds in these high-yielding private real estate notes. Sooner rather than later, you'll be following the same path that Romney, Trump, and Buffett have been using to grow their wealth at an accelerated rate. Now, if you're going to use your self-directed IRA strategy or not, if you're going to invest in opportunities as a real estate investor presents, I want to give you some pointers on how to qualify the real estate investor and his team as a good person to invest in. Alright, I've narrowed the list down to 7 qualities in no specific order, but these lucky 7 will help you in choosing the right real estate investment team to invest in. The first 3 is their knowledge, experience, and track record. The 3 go hand in hand. Someone with a lot of book knowledge but who lacks real-world real estate investing experience, who has not been beat up or not made mistakes, lacks the wisdom gained through experience. More often than not, we learn more from our failures than we do our success. Now, how do you test their knowledge and experience? Well, the easiest way is to ask them questions, specific questions about their prior and current investments. If they're doing business, they should be able to prove it to you by presenting a portfolio of private deals and a list of investments that they're currently doing right now. Go ahead and ask them, have they ever failed? Have they ever lost money? And I'm telling you something, if they say no, they're either not being honest, which means do not invest with them, or they don't have enough experience, meaning they haven't done enough business to make mistakes and failed. Either way, I would not feel comfortable investing with somebody like that. Now, something else to consider. Should you invest with a real estate investor who has a team or who works solo? Now, that's really a personal preference. Some may argue that if you invest with a solo person who does everything themselves, that they won't miss anything. But to me, if someone's doing it all, they're going to miss things. There is just no way to keep up with everything. There's way too many moving parts if they have a real estate in business. It makes more sense to invest in a business that takes the team approach, one that has key players in each role responsible for a specific arm of the company with oversight from the company owner or its management team. A quality team will consist of a marketing team, an acquisitions team, a project management team, a liquidations team, and an internal administration team. It will also consist of a legal team, title company, mortgage banker, and a host of others. Now, as I've mentioned earlier, it's really a personal preference, but I'd rather invest with somebody who takes the team approach. Now, one key ingredient you must look for in a real estate investor is one that has a proven system for doing their business. The key words here are system and proven. There's a very good book out there called The E-Myth. It stands for Entrepreneur Myth, and it's written by Michael Gerber. In it, he explains the most successful businesses are those that systematize every step of their business. They document their business processes, they use checklists, forms, methods, and other workflows to minimize mistakes and to do things the same way every single time. It allows a business to get a consistent results from their efforts. Now, this is critical in real estate investing. You want your real estate team to have proven systems that they use in their business. I cannot emphasize this point enough. Now, you can find out if they have systems by asking. Ask to see the process in which they analyze the ARV, or the system in which they figure out the repair costs, or the system used to figure out their profit on a property. In a nanosecond, you'll know if they have and they use systems or not. If they don't, I would not be willing to invest with them because it basically means they're going to be shooting from the hip. If they don't have a systematic way of finding deals, of figuring them out, of knowing what the profit is, of knowing what the rehab should be, then they're winging it. And if they're winging it with your money. And that's the last thing you want to do. Lastly, we have transparency and credibility. You really want to work with people who are transparent. Someone who shows it all and tells it all. Tells you about what they've done, how they've made their money, and more importantly, how they've failed. You're looking for those who put it out there, who disclose everything. You'll get a good sense again by asking questions and by getting to know the people, by looking at everything they've done, what they're doing, by the way in which they're answering your questions. Someone who kind of skirts the questions may not be answering the questions directly. It's probably not being transparent. Now, by going through the above 7 qualities, you'll be able to make a determination if the person is credible or not. If they have a high knowledge base and experience with a track record they can prove, and if they do things in a systematized way, and they're open and honest and trustworthy, they more likely than not have the credibility to invest with. But I can assure you, finding these individuals, the ones you want to build a relationship with and invest in, will not be an easy task. This leads us to the final piece of the 12% solution puzzle. How do you go about finding experienced, credible real estate investors to invest with? Over the last 6 years as a real estate investor myself, my private investors have found me in 3 ways. Through word of mouth, referrals, and through networking, and of course through friends and family. Now, I've gotten a lot of my private investors through word of mouth and referrals. For instance, other private investors like attorneys or accountants or past realtors and business associates referred their friends and family members over to me. Now, networking has also been a blessing to me. You can go out to the RIA, which is a real estate investment group, and other networking meetings to find real estate investors. However, I want you to keep your guard up. A lot of people who go to the RIAs are newbies, and as I mentioned earlier, you'll want to invest in an experienced person or company, not a newbie. Finally, maybe your friends or family members are real estate investors, or maybe they know somebody who is. Now, using these 3 or 4 ways will get you going and get you meeting some quality real estate investors. But don't get up and get discouraged. Eventually, you will find the right person, and you'll quickly start earning 12% on your money. Well, there you have it. The 12% solution is now yours to invest in. Over the last 45 minutes to hour or so, I've explained the differences in how to build wealth through private investing versus other more traditional methods. I've shown you how it grows your money 6 to 7 times faster, how to secure your investment, what to look for in investment, and the formula needed to ensure that you minimize your risk, and a host of other items. So as a wrap up, I want you to remember, anyone with a minimum of $50,000 or more can become a private lender. I want you to never invest more than 70% of the loan to after repair value. I want you to know that you could earn higher returns than most other investments, that these are usually fixed at 12%. And as a wrap up, I want you to know that all of your investment is fully collateralized by real estate and secured by a mortgage. I want you to also remember that you want to invest in experienced investors and quality projects. And very important, if you have an IRA or 401k, or if you need to set one up, you need to get that portion of your wealth building program going immediately. It will transform your life. Well, there you have it, folks. The 12% solution is now yours to invest in. And as I said in the last slide, over the last half hour, 45 minutes to an hour, I've explained the differences in basically everything that you need to do in order to get started. Now, if you want to contact me, what you can do is you can reach me at 800-793-5015, extension 702. You could also reach me here at my email address, which is balvaro@maxreturnsrei.com. And if you want to find out more about us online, you can go to maxreturnsrei.com. If you have any questions about private lending, private real estate investing, earning 12%, if you're confused, if you want to get some of these questions answered they may not have covered in this presentation, by all means give me a call. Now, I may not answer my phone. As a matter of fact, I know I'm not going to answer the phone, but you can simply leave your information on there, leave your first name, your last name, and what this is in reference to, and make sure you leave contact information, and I will definitely, within a few days, get back to you, schedule an appointment, and answer any questions that you may have. I wish you all the best in your new ventures. I hope you utilize the information that you learned in this educational series. And remember, nothing will change unless you take action. So I want you to take this information and I want you to immediately start to apply it in your life and start earning 12% on your money. Take care.